For the longest time, when we talked about the digital economy, there was this very simple, very visible concept that I think everyone understood.
Right, the everything store.
Exactly, the everything store. You log onto a website, you click a button, and like 2 days later, a brown box just shows up on your doorstep. For a decade, that was it. The entire narrative was just about the storefront.
Well, the storefront was the initial revolution, you know. The ultimate goal for these tech companies used to be aggregating as much merchandise as humanly possible into one single digital location. It was really all about having the widest shelf space on the internet.
Right. But looking at the massive stack of strategic equity research we have in front of us today, that era is over. I mean, the era of the everything store is completely dead. We are now standing squarely in this new paradigm, which analysts are calling everything infrastructure.
It is a profound shift and an incredibly expensive one. The competitive moat of a global tech firm, it's no longer measured just by its gross merchandise volume or, how many consumer items it sells.
Yeah.
Instead, supremacy is basically being measured by the density of a company's proprietary artificial intelligence compute layers and the total autonomy of its logistics networks.
Okay, let's unpack this. Welcome to the deep dive. Today we are taking you on a highly detailed, very data-heavy exploration into two absolute titans of global commerce, Amazon and Alibaba.
Two absolute giants.
Yeah, and we are going to look at how both of these entities are currently executing these historic multi-billion-dollar capital pivots. I mean, they are racing to become the foundational AI infrastructure for the entire global economy.
What makes this so compelling to me is the contrast. You have these two massive companies, right?
Yeah.
Operating in different hemispheres, dealing with completely different economic realities and, well, regulatory pressures.
Right.
Yet they have independently decided that the future isn't just selling things. The future is owning the actual intelligence and the physical plumbing that allows the rest of the world to sell things.
So let's start with the architect of the Western digital infrastructure, Amazon. But before we get to the company itself, let's look at the board they are playing on. I'm looking at this report's assessment of the U.S. economy in early 2026, and it describes it as having bifurcated resilience. What does that actually mean on the ground?
So bifurcated resilience means we are essentially seeing two contrasting economic realities existing at the exact same time. On one hand, you have real sustained inflationary pressures on the supply side. Sourcing alternatives for retailers are becoming costlier.
Because of the tariffs, right?
Exactly. A huge part of this is tied to the recent removal of the de minimis tariff exemptions.
Right. And just for context for you listening, the de minimis exemption was essentially a shipping loophole. It used to be that shipments coming from overseas under a certain dollar amount, I think it was usually around $800, could basically bypass customs taxes and tariffs entirely.
Yeah, they just sailed right through.
But with that gone, importing cheap goods is suddenly much more expensive, and that is completely reorganizing global trade flows.
Precisely. That is squeezing profit margins across the board for traditional retail. But on the other hand, and this is the resilient side of that bifurcation, the American consumer remains highly active and, crucially, incredibly tech-enabled.
They're still buying.
They're still spending, but how they spend is changing. This dynamic has resulted in the information technology sector commanding these incredibly high price-to-earnings ratios right now. They're hovering around 40x. The market is basically pricing in the massive, almost incomprehensible earnings potential of AI and cloud computing over the next decade.
So tech is priced for an economic golden age, even while everyday physical logistics are getting severely squeezed. So how does Amazon fit into this? Because I think a lot of people still look at Amazon and just see, an online bookstore that got wildly out of hand.
A lot of people do, yeah.
But the shift here is staggering. To really understand Amazon today, you have to compare it to a city's plumbing system. You only ever notice the faucet. That's the retail website. You turn it on, the product flows out. But the real value, the actual marvel of engineering, is the thousands of miles of hidden pipes running under the city.
That is the exact way to visualize it.
Right, and for Amazon, those pipes are its global logistics network and its massive cloud compute infrastructure.
Yeah, Amazon has fundamentally transitioned from a cyclical consumer retail play into a structural utility. To understand their scale today, we have to look at the three main pillars of their operation. First, you have the 1P retail, where they act as a traditional retailer, buying wholesale and selling goods directly to
A
you.
classic Amazon.
Exactly. Second is the 3P marketplace, where they provide the platform, the warehousing, and the shipping for millions of independent businesses. And third, there is AWS, Amazon Web Services, where they literally rent out raw compute power, data storage, and AI tools to governments and corporations globally.
And their product ecosystem, I mean, it doesn't even stop there. They've got Prime Video, Whole Foods, Project Kuiper, which is that massive satellite internet initiative they built to rival Starlink.
Oh, Kuiper's huge.
Yeah, and they are currently rolling out these Proteus autonomous robots across all their fulfillment centers.
And if we break down the exact revenue splits for 2025, it paints a very clear picture of how much they've evolved away from just being a store. Their online stores, so that direct 1P retail, made up 38.9% of their revenue.
Okay, so less than 40%.
Right, which comes out to roughly $82.99 billion. But look at the third-party seller services. That now accounts for 24.8% of their revenue, bringing in $52.82 billion.
Wow. So providing the infrastructure for others to sell is rapidly catching up to them, just selling things themselves. And geographically, where is all this money coming from? North America is still the absolute beast of the operation.
Oh, by a wide margin. North America brought in $426.3 billion.
That's wild.
Yeah, which is actually up 10% year over year. Their international segment generated $161.9 billion, up 13%. But the real engine of profitability here is AWS. It came in at $128.7 billion, but it is growing at a massive 20%.
20% growth on over $100 billion in revenue.
Exactly. Enterprises are desperately migrating their workloads to AWS just to get access to Amazon's foundational AI models and their custom silicon chips.
Okay, so we are about to get into Amazon's actual cash flow numbers. And frankly, looking at this data, I am seeing a massive red flag that we definitely need to debate. But before I drop this bombshell on why their cash position looks so alarming, I need you to take 1 second right now to hit subscribe, like, or drop a comment down below if you're watching on YouTube.
Please do.
Because the algorithms on these platforms change daily, and your engagement is literally the only way we can ensure you don't miss out on these deep dives. It takes us hours to distill a 100-page equity report into actionable intelligence, and we want to make sure this research actually reaches your feed.
It truly makes a difference in our ability to keep breaking down these really complex financial shifts.
All right, so let's get into these financials. Amazon's total net sales hit an incredible $716.9 billion. AWS operating margins are sitting at a massive 35.4%.
Which is huge.
It's massive, meaning they're keeping a huge chunk of every single dollar the cloud brings in. But then I look at their free cash flow, and it plummeted 71% year over year.
Yep.
It's down to just $11.2 billion. For a company making over $700 billion in sales, how is that not a catastrophic drop? Are they spending too much too fast?
I know it looks terrifying on the surface, but if we connect this to the bigger picture, that drop in free cash flow isn't a failure of the business model. It is a highly calculated, highly deliberate strategy.
Okay, so where did the cash go?
That 71% cash drop is the direct result of Amazon deploying a staggering $128.3 billion in capital expenditures in 2025 alone.
Over $120 billion. Just gone.
And even more wild, they are projecting to hit $200 billion in CapEx in 2026.
Wait, $200 billion? Just on infrastructure?
Exactly. They are willingly suppressing their short-term cash flow to build an insurmountable AI and robotics moat. They are buying the servers, they're building the multi-gigawatt data centers, and deploying the autonomous robots today so that no competitor can possibly match their physical and digital scale tomorrow.
Okay, so what does this super aggressive spending mean for the valuation? Amazon is trading around $211.71 right now.
The consensus among the analysts in this report is that the stock is currently undervalued. They estimate the real intrinsic value is closer to $247.78. If you look at their trailing PE ratio, it sits at 29.5x.
Which is actually significantly cheaper than that broader information technology sector average of 40x that we mentioned earlier.
Right. Which leads to the core investment thesis here. Amazon is largely considered a strong buy or a hold candidate right now. The main argument is that this massive capital expenditure is building a structural advantage in what the industry calls agentic AI.
Yeah, let's define that because it's a critical distinction. We spent the last few years talking about generative AI, like a chatbot that can write an email or answer a trivia question. Agentic AI is the next evolution.
It's a huge step up.
It is. It's an AI that actually executes tasks on your behalf across different software ecosystems. Amazon already has an AI assistant named Rufus, which is currently being used by 300 million customers.
Mhm.
And according to the data, it's already driving $12 billion in incremental sales.
But as an investor, you really can't ignore the risks, and there are several immediate threats here. First, you have macro fuel risks. Wolf Research published a note pointing out that if U.S. diesel prices spike over $5 a gallon, that could hit Amazon with $400 million in extra logistics costs in Q1 alone,
Ouch.
and up to $1.2 billion in Q2.
Right, because at the end of the day, those millions of physical packages still need to actually move on trucks. They also have an FTC antitrust trial looming in October 2026, which threatens their core business practices. And interestingly, the report notes AWS actually suffered localized disruptions in Bahrain recently due to regional drone activity.
Yeah, that was fascinating.
It really shows how physical geopolitics can impact digital cloud operations.
It is a very complicated landscape, but when you compare Amazon to its primary rivals, you start to see the unique position they hold. Think about Walmart. They have a massive physical footprint and retail dominance, sure, but significantly lower AI infrastructure density.
Right.
Microsoft has a stranglehold on enterprise software with Azure, but they completely lack the physical logistics network. Alphabet dominates search and cloud, but Amazon is the only one blending the digital compute layer with the physical delivery layer at this kind of global scale.
And here's where the strategy gets really interesting. Let's talk about the latest developments, specifically this massive $50 billion OpenAI deal. I was honestly geeking out over the mechanics of this because it is just a masterclass in corporate lock-in.
Oh, that's brilliant.
Amazon is investing $50 billion into OpenAI, but they're doing it in two very specific stages. First, they're injecting $15 billion in Series C stock right now. Then, there's a $35 billion commitment tied to these heavily redacted holders.
Yeah, the SEC filings are very tight-lipped on the exact mechanisms, but those triggers include things like OpenAI confidentially filing for an IPO, or what the documents call a mandatory funding event, the details of which are entirely blacked out.
But look at what Amazon actually gets in exchange. AWS secures exclusive third-party distribution rights for OpenAI's Frontier enterprise platform. But even more importantly, OpenAI legally commits to using Amazon's custom-built Trainium chips for their massive compute workloads.
Which is the real prize here.
Exactly. Why does that matter? Because it forces the world's leading AI company to build its foundational architecture on Amazon's proprietary physical hardware. It makes it incredibly difficult for OpenAI to ever migrate those workloads to Google or Microsoft.
It is a brilliant defensive play. And alongside their digital investments, they are pushing hard into physical automation, too. They are expanding their Zoox autonomous robotaxis into Austin and Miami, and they just acquired Fauna Robotics to further automate their warehouses.
So when you synthesize all of this data, analyst predictions for Amazon's future price converge around a consensus target of $286.66. The bull case, which could push the stock to the $340 to $360 range, heavily hinges on them winning massive government contracts for Project Kuiper and sustaining their AWS growth rate.
And the downside.
Well, the bear case, bringing the stock down to the $175 to $190 range, relies on the FTC successfully forcing a breakup of the company or, a severe consumer spending slowdown that tanks their retail margins.
So Amazon is basically spending pure cash flow to build an absolute monopoly in the West. But while they are busy laying the AI plumbing for the Western Hemisphere across the globe, its Eastern counterpart is trying to pull off the exact same infrastructural pivot.
Right, Alibaba.
Yes. The difference is Alibaba is playing this game while dealing with an entirely different set of economic gravity and a geopolitical supply chain that is constantly under threat.
Okay, let's pivot to Alibaba. Set the macro stage for us. What does the economic reality of China look like in 2026?
Well, GDP growth is moderating, settling into a target range of 4.5 to 5.0%. The country is in the middle of a deliberate, highly complex economic transition right now. They are shifting their economic engine away from the traditional real estate and property sectors and moving heavily toward what they categorize as strategic emerging industries.
And the AI boom happening there is just staggering.
Yeah.
The report notes that China's intelligent compute capacity is expected to hit 1,037 exaflops this year.
It's massive.
For context, one exaflop is a billion calculations per second. It is a level of compute power that is almost hard to even conceptualize. And they have a domestic base of 515 million generative AI users.
Now, it is absolutely crucial to state here that we are looking strictly at the market data and the financial mechanics today. There are significant macroeconomic risks tied to ongoing U.S.-China trade tensions, export controls, and the removal of those de minimis tariff exemptions we discussed earlier. So looking at Alibaba, the company, they recently went through this massive structural overhaul known as the 1+6+N restructuring. Essentially, they realized they were getting way too bloated and slow, so they broke themselves down into four main agile pillars.
Right. You have the China e-commerce group, which houses their dominant domestic platforms, Taobao and Tmall. You have international digital commerce, or ADC, which runs their overseas operations like AliExpress and Trendyol.
Trendyol is huge in Europe right now.
Yeah. Then there is the Cloud Intelligence Group, which is critical because it houses their proprietary Qwen AI models. And finally, Cainiao Smart Logistics, which handles the physical movement of all these goods.
Let's look at their operational shares to see what is actually growing. China e-commerce brought in RMB 159.3 billion, which is up a respectable 6%. International brought in RMB 39.2 billion, up a very healthy 24%.
Okay.
But the absolute standout is the cloud division, bringing in RMB 43.3 billion. That is a 36% surge.
36%.
Yeah.
The top line shows very clear growth across all sectors, but
Yeah.
It is the bottom line that completely startled the market.
Startled is putting it mildly.
Yeah, I mean, net income collapsed by 66%, dropping down to RMB 15.6 billion. Just like we saw with Amazon's cash flow drop earlier, this looks like a massive red flag. If I'm an investor looking at a 66% drop in profit, how do I know this isn't just a legacy tech giant bleeding cash as it loses market share?
It is a totally fair question, and it really requires understanding capital cycles.
Mm-hmm.
This net income drop isn't a failure of their core retail business. Like Amazon, it is a deliberate, highly aggressive investment phase.
So they're spending it all.
Yes. Alibaba is willingly sacrificing its short-term profit to build out two specific things. First, its quick commerce delivery network, which requires massive localized warehousing. And second, its AI infrastructure. We are seeing a 69% increase in sales and marketing expenses as they fight brutally for market share.
So they're basically bleeding cash now to own the compute of the future. Let's look at how the market is pricing that risk. Alibaba is currently trading around $125 to $129. But the discounted cash flow analysis implies a fair intrinsic value of roughly $185.67.
Which means it is deeply undervalued by traditional metrics. The PE ratio is sitting at about 20.8x. To put that massive gap in perspective, the rest of the Shanghai Stock Exchange tech sector is currently trading at an average PE of 73x.
Oh, wow. 73x versus 20x.
Exactly. The market is pricing Alibaba like a dying retail dinosaur, completely ignoring the massive AI infrastructure they are currently building.
The investment thesis for Alibaba right now is that it is a deep value play that comes attached to a massive AI call option. You are buying the traditional cash-generating e-commerce business at a steep discount, and you are essentially getting the explosive future potential of their cloud and AI infrastructure for free.
But the risks holding that price down are very real. The cash burn required to win the quick commerce war is intense. There are ongoing European Union regulatory probes into AliExpress regarding product safety and counterfeit goods. And of course, the ever-present geopolitical fractures and Western export controls restricting their access to high-end silicon chips.
And competitively, Alibaba is fighting a brutal war on two fronts. On the e-commerce side, they are battling PDD and Temu, who are just ruthlessly undercutting them on price. On the social commerce side, they're fighting ByteDance and Douyin for consumer attention.
It's a squeeze from all sides.
And that's not even mentioning Tencent in the cloud space and JD.com in premium logistics. So how do they defend against all of that?
Well, their unique edge is what analysts in the report call their vertically integrated AI stack. Alibaba isn't just building consumer apps. They're combining their own cloud infrastructure, their proprietary silicon chips, and their consumer applications into one unified, closed-loop ecosystem.
And that brings us to the latest and frankly most stunning development in this entire report. Alibaba just unveiled their proprietary 5-nanometer Schwanti C950 AI chip.
A 5-nanometer chip?
Yeah, but the key detail here is that it is built on an open-source RISC-V architecture. Why does that matter? Because RISC-V is essentially a public open-source recipe for building a computer chip. Because nobody owns the architecture, Western export controls cannot legally block Alibaba from using it,
Right.
to use an analogy. It's like Alibaba realized they might get cut off from the global power grid, so they just went ahead and built their own state-of-the-art nuclear reactor in the backyard using publicly available blueprints.
And again, maintaining our strict neutrality on the politics here, we have to look at this purely from a strategic business lens. This move is entirely about technological self-reliance in the face of ongoing geopolitical trade tensions. By successfully designing their own 5-nanometer silicon on an open standard, they are materially de-risking their cloud unit from external supply chain shocks.
And they are backing this hardware up with serious capital. Alibaba's management has laid out a $100 billion strategic bet over the next few years. The ultimate goal is generating $100 billion in annual cloud and AI revenue. Furthermore, their Kuo 3.5 open-weight AI model is seeing massive adoption success among developers.
So when we synthesize all these factors, the future predictions for Alibaba's stock show an analyst consensus target of around $188 to $192.
The scenario breakdown looks like this. The bull case pushes the stock to the $230 or $250 range, but that heavily relies on successful, broad macroeconomic stimulus from the Chinese government that actually trickles down to consumer spending alongside further cloud acceleration.
And the base case?
The base case is that $185 to $200 range, and the bear case drops the stock all the way down to $95 to $115. That bear scenario triggers if China enters a deep, sustained recession, or if we see intensified chip export curbs that manage to bypass Alibaba's current open-source workarounds.
If we connect all of the data points from both of these deep dives, they reveal a stark, almost intimidating reality about the future of global business. I mean, we're looking at Amazon dropping $200 billion on capital expenditures, and Alibaba making a $100 billion strategic bet just to build their own silicon and servers.
So what does this all mean for you, the listener? Why should you care about these massive CapEx numbers?
Because it forces us to ask a rather provocative question about the future of competition itself. If the future of global commerce requires hundreds of billions of dollars in AI infrastructure and proprietary silicon just to compete, are we rapidly approaching a world where only 2 or 3 mega corporations own the literal compute of human commerce?
Wow.
What happens to the mid-sized players or even the large traditional retailers when the absolute bare minimum price of entry into the modern digital economy is a $200 billion server farm?
It's a staggering thought. The hidden pipes beneath the city are becoming so impossibly expensive to build that soon only 2 or 3 companies might own the entire global water supply. Before we go, a quick reminder that investing inherently involves risk. The market is highly volatile, and you should always do your own rigorous research before making any financial decisions. Thanks for joining us as we mapped out the new digital infrastructure. Keep questioning the consensus, and we will see you on the next deep dive.